What video is this, number 8?
6 technically. Technically 7, because there's 2 parts to 5.
And we're talking about finances with people. We can't count.
Yeah. Well, C is part A and part B.
Part B.
Which is technically 2 videos, so it should be 5 and 6, so this should be 7.
Are we entertaining enough?
Yeah.
We think we're entertaining enough. We have children.
We're not entertaining enough. But I can make our voices
Just go like really high, like chipmunks. That'd be entertaining. It's gonna be like on the outtakes.
Stakes are really low, yeah. This is us when we are off the cuff.
Hello, I'm Tom.
And I'm Brian.
We are the Dividend Dudes, speaking to you off the cuff, unplanned, and unhinged today.
It's going to be rough.
Probably. We had a couple things we want to talk to you about today. We've got a 2-part video series that's going to kind of pick up on the last set of videos that we've been talking about. Today we're going to be discussing dividend payout ratio, and one of my personal favorites, nerdy things like Star Wars and it's price to earnings ratio. We're going to talk about price to earnings ratio. So I'm a nerd. I don't get out much. Sorry, people. So as highlighted by my wonderfully purple shirt.
It's very magentic. It's like kings.
Majestic
emperors.
or magentic?
Majestic.
Majestic, yeah. Yes. So like I said, today's video is off the cuff. So first things first, we want to talk about the item that relates to earnings per share first. So that's going to be the dividend payout ratio. So when we talk about the dividend dudes, we're talking about getting dividends. It's kind of how that works.
The idea, right?
Right. So as far as the payout ratio goes, if you're going to take some formulas here, and if Brian posts videos, he likes to edit the videos, and we could put it here or there, like over my face. Don't put it over my face.
Maybe.
But so this is the percentage of dividends divided by their net income. So as far as what you would use this for is if you take their net income and they make, let's say, $100, and they pay all of that $100 back to their shareholders in form of dividends, well, their payout ratio is 100%. That's not exactly good. That leaves absolutely no money left over for them to do anything.
It's great for us short time because we're going to get 100% of their earnings, but long term they're not going to be able to grow their company, and we'll probably end up not getting dividends from them for very long.
Yeah, so back when we talked about earnings per share and your net income, and we kind of went into some of the other factors that you want to pay attention to when you're looking at, like, okay, does earnings per share actually mean what they say it's going to mean? These 2 things will help you get there. They're not the only things, but they're going to help you kind of understand, is that an accurate or is that a good price for the company that you're about to buy? On another note, we've had a couple people ask us some questions about, should I buy this company? They're paying a 10% dividend. That's a huge dividend. Most companies, if you look at the dogs of the Dow, or the Dow Industrial, or the NASDAQ, or any kind of the predefined strategies out there, I mean, you'll find it paying between 1% and 4%. Typically, once you get over about 3%, it becomes hard to make that up. Now, there's exceptions. There's companies out there called real estate investment trusts, or REITs. They have different laws surrounding them, where they have to pay usually 90% of their profit. It depends on the REIT that you buy in the form of dividends. So there's always exceptions to the rule. But if you're looking at a generic index fund, if you look at most major indexes, they'll tell you that stocks are going to grow somewhere between 6 and 8% per year, plan on 6. So if you are a company, and we're discussing dividend payout ratio, if they pay 6%, that's pretty hard to make up. So 3% is probably cutting it a little bit high. That still gives them a little bit more money left over based on things like inflation, generic growth trends, the devaluation of the dollar over time. That's the Fed's job.
Inflation.
Inflation. He said, if we're going to say it again, inflation.
Inflation.
So to make it so that they can pay it back. So to summarize, your payout ratio is going to determine whether or not a company continues in healthy fashion to be able to pay their dividend over a long period of time. That's mostly what it's for. Anything over 100%, not really that good. Usually you don't want to cut into net income for the ability of the company to grow or at least reposition itself to stay successful. So on that note, what I use them for is basically to see whether or not my dividends are going to be consistent. I tend to be a little bit more fundamental and contrarian to my stock purchases personally. So if I'm buying it, I have a relatively high dividend payout ratio for the companies that I buy. Why do I do that? Well, a lot of times if the stock drops, and we'll get into this in the next video in the series, the PE ratio will be low and the payout ratio will be high, because these things are usually determined, it depends on the company, but it's usually every quarter, every semi-annually, or every year. Some companies don't make these disbursement declarations annually. So if everybody sells their stock and the company's relatively healthy, you're going to see a pretty high payout ratio. Again, it's not the only thing you want to look at when you're buying a stock, but it is something that's very healthy to know. If companies pay over 100%, you probably want to look elsewhere, because again, they're paying more than they make in the form of dividends. How long can you do that? It's like buying a credit card and never paying it.
Right. But it goes along with what we started with in our videos, is the asset test and all those things to see if you want to use this company as an investment. And then we're going into the PE ratio to find out if, okay, the company looks sound. What are they paying out and why? Now, why would a company pay 100% of what they're earning?
Sometimes companies just don't have anywhere to put the money. I mean, so they make a disbursement declaration that says, well, we don't have anything to do with this right now, here you go. There's a reason for that. It's attractive to shareholders. It makes the stock look more, profitable. Maybe the stock price hasn't gone anywhere for a whole year, and that's one way that they can make it so that you still have relatively good gains over the year in the form of a dividend. In other words, there's about a million reasons why.
To attract new investors, maybe?
It could be that they don't want to have, now you're going to hear cash flow is king. Cash flow usually is king, but you don't want to sit on too much cash, especially not right now. We're talking March 2022. Inflation is the key word. Gas prices are crazy. Russia went crazy. There's a lot of things that are going on right now.
Interest rates are going up.
Yeah, so if you have cash and interest rates and inflation are really high, that's no good. So if a company has a lot of cash that they're sitting on, they don't have anything to do with it, they basically say, okay, well, here you go. That makes it so it's more attractive to people that hold it. Well, maybe the investors don't like the fact that they don't have anything to do with that, and they might sell their stock and go somewhere else. That's one way that they can keep a hold of their shareholders. So, it differs per company.
Right.
Some companies, again, are required by law to regulate that. Most of them just don't have any incentive to pay any dividends at all. They do just to make it attractive for people.
Right.
So, dividend payout ratios, when you make money, so if a company pays 5% dividend, the stock only goes up 5%, that's a 10% gain. That's treated as a gain. We'll cover that in section 2. But one thing I want to cover with this payout ratio is a lot of people that I've talked to personally, and you've seen this too, where when they buy the company, they're like, well, it pays this really big dividend. It pays 12%,
right,
or it pays 7 or 8%. When you buy a company, we've covered this a lot. You're buying the whole company. You're buying the assets. You're buying the building. You're buying the cost of the employees. You're buying their product that they produce. So you need to make sure that when you're buying this, that it's a good long-term buy. Anybody who buys in the short term, most people I've seen that buy based on huge dividend payouts right out of the gate end up finding out that the dividend gets cut because they can't afford it. So one of the ways to get past that is in the payout ratio. If it's too high, that's a way to help you avoid that. So if you're a new investor and you want to figure out, does this look like it's a company that can pay really most of what they're telling you that they can, that's one way to find out.
And we're hoping that you did all the prior research to come up with this company in the first place, to see if they're paying their bills, see if they're making money in the beginning.
Right.
So then when you get to this part, are they using that money wisely?
Yeah, and it's a good idea too to pick companies that you understand. I mean, if you don't understand crypto, don't buy crypto. If you don't understand oil companies, don't buy oil companies. If you don't understand any of the companies, buy an index fund.
There you go.
I mean, but it's important to understand the industry that you're in, and you want to diversify within that industry. So one of the strategies that I use, we'll get into the next video, covers a little bit about that price to earnings ratio, how that plays into the dividend yield and some of the other things, and then we covered the earnings per share. Some of this references previous videos, but we're hoping that this video was very helpful to you, and we'll see you on the next one. Unless you got anything to add?
I've got nothing.
You got nothing?
No, I think a lot of it is going to be explanations for the next video to figure out how we're going to use this and why.
Okay. We got it.
All right.
Happy investing, everybody. See you in the next one.